Welcome to the AJ Brown Show, where we talk about all things investing, options trading, and the like. Now here's your host, AJ, whose primary mission in life is to help you become a better investor.
All right, ladies and gentlemen, welcome back to another episode of the AJ Brown Show. My name is Cyprian Francis, and with me, as always, AJ Brown, the host of the show. Hey, AJ, you must have a busy week. You're heading off to the Super Bowl this week.
That's
that's
pretty cool, right?
That's
That's
the
the
other
other
AJ
AJ Brown.
Oh,
Yeah. He's
I
gotten
was-
popular throughout the years, hasn't he?
I was gonna say you're quite the Superman, killing it in the options market, heading out on the weekends. Playing
Packing
some
on
football.
200 pounds of muscle.
Yeah, I mean he's a good player. It's not this weekend, it's next weekend. The Super Bowl is next weekend.
Yep.
Today is February 3rd, 2023. Oh my gosh, AJ, already into February.
Yeah.
And I feel like we had a lot of action this week. Where do we begin? Do we begin with the Fed? That was the big news this week. That's what we were waiting on.
So let's start with the Fed. So if I take a look at the economic calendar, and I'll put it up right here. The economic calendar back on Wednesday, we had our Fed announcement. So this was interesting. Here at Trading Trainer, we talk a lot about the three ways that the Fed is moderating or controlling the economy. Number one, through interest rates. Number two, through bond selling and buying. Now they're doing mostly bond selling. And number three, through their rhetoric. So what did they do? They did exactly like everybody expected. They raised interest rates by 1/4 point. If I take a look really quick at their bond selling, we had noticed that they had stalled in some bond selling while, there was some teetering a couple of weeks back. Well, they're back at it. As you can see, they're selling bonds again, not quite at the aggressive rate that they were in the fall, but it's resumed. So they're back selling bonds. But then they come out and they have their press conference on Wednesday, and everybody was expecting them to be as hawkish as they have been. Instead, Jerome Powell came out quite dovish, quite impressed with the first signs of slowing down of inflation. And he's like, I'm happy with that. And we're really impressed that the employment market hasn't crashed. So our Federal Reserve, different than a lot of central banks, has a dual mandate, which sometimes or most of the times are at odds with each other. One of them is to keep Americans employed, and number two is to keep interest rates, keep growth at a certain level, monetary policy. And so they're happy that employment isn't crashing. So a lot of investors after that speech, and of course, the Fed always has a but. So if you listen closely to his rhetoric, he did say, but we're staying the course and we're going to continue to target lower inflation. But a lot of people think he's going to do another 1/4 point rate hike in March, which is the next Fed meeting, and then kind of calm down and let it go through the system. We talked about that last week, and actually for the last few weeks, that it takes a while. And the Fed has raised rates the last 8 sessions, which is unprecedented. Also unprecedented is that 4 of those were 3/4 point rate hikes all in a row. Unprecedented, never done before. So we kind of have to see. I think it's early time, Sip, to really be excited about employment. At the same time, we got our employment numbers this morning. Let's talk about that.
Yeah, that was the big headline, and you mentioned it. Employment was good, but it was really good.
Yeah. So if we take a look at the employment numbers, but I want to focus, let's cover what everybody's talking about, the talking heads. So when we look at, they always come at the employment numbers with a stab at what it is, and then they come back a month later and they recount and come out with a more accurate number. So for December, they came at us with 223. After they recounted, they came at us with a lot more, 260,000. This time around, they were expecting 185,000. 517,000 new jobs
Wow.
created, according to their survey. Then you look at the unemployment rate. Instead of it going down, getting worse, it actually went down, which is better. So that's pretty cool. Private payrolls, manufacturing's all outperformed. Here's something that I always look at that's often overlooked. This is how many people are actually participating in, they're not just taking themselves out of the job market, and it keeps ticking up. So that's like good news. But what that also means is that people are getting a little bit more uncertain and not wanting to go without a job. So there's more people coming back into the labor, which should actually help with the whole moderation of inflation, because one of the things that's been problematic is that there's been more jobs than people. So if more people come back to the workforce, that should calm things down. But here's what I've been noticing, and this is really good news. The average hourly earnings has been going down, right? And so that's one of the things the Fed wants to have happen, is that they want people's paychecks to flatten out instead of keep going up every year. And so, because that's inflation too. Inflation is not just seen at the supermarket, but inflation is also seen in people's paychecks. And so you'll notice that, they were expecting 4.4. That's a lot less than what they got in December, even after revision. So that's good news. And also seeing that more people are spending more time at work is other good news about this.
And so when we look at this data, it maybe in a longer lens, like 12 months or so, it's things are starting to flatten out, right? And so maybe that was the catalyst to the dovish comments, right? We want to see the data like this to continue to come out.
So you'll notice if we take a look, and I want to show one more thing, and then I want to take a look at the S&P 500. There's one more thing I want to take a look at, and that was on Wednesday. There was this job opening and labor turnover survey, which on it, when they reported their hard numbers, it shows that, hey, there's still a lot of job openings that are going unfilled. In fact, more than expected. But if you look at this report even closer, another thing that you notice is that the labor turnover, this means the amount of people who are like, I'm okay to leave this current job because I can get a better job. That number has plummeted since this fall, meaning that people are kind of staying put. And that's like a psychological experiment. What we're seeing here is that people know that there's, that it's getting tighter, and that they can't just be willy-nilly leaving jobs knowing that they're going to have a better job on the horizon. So people are kind of staying put. All of this is really great news. The employment report today and this job openings labor turnover survey on Wednesday. But you'll notice at the S&P today, let me go ahead and bring up our S&P 500 chart here, and we'll look specifically at what's happening today. I think you'll notice that we gapped down on open today. In fact, let me zoom in. That way you'll be able to see it a little bit better. We'll look at just the last 3 months of data. So you'll see that we really popped up on Thursday when people were like, the Fed is talking about being calm here. But then today we gap down. We do have some positive gains today, but we're not anywhere near where we opened yesterday. And so what that kind of, I think people are taking into consideration here is, if things are so good, the Fed doesn't need to slow down. In other words, the Fed has more room to take more drastic measures to control the economy because they're not as worried about squashing employment. So I think that's causing investors to think about things today and kind of slow down on their buying. I don't know if this is fleeting for just today and next week it'll pick up again, or if people are going to be like, yeah, things are so good that the Fed might decide that they can be hawkish again.
Yeah, I feel like that employment number today is really throwing a wrench into the week and the sentiment, because it is almost like double the consensus, and that it's rare to get data that comes out that far from the consensus, especially in January, right? Because don't we usually get a fall off in jobs because of the holiday, right? So that is very, very surprising.
Yeah. Yeah, I think we better watch this a little bit closely, because sometimes when economic news is too good, investors react negatively, like it's too good to be true. It's kind of like a psychological experiment.
All right. So we'll keep an eye on that. In addition to that big economic news this week, it has been earnings week. So we have been getting a lot of earnings. I know on our last episode we did a whole segment on earnings. I think even the week before we were talking about earnings. And so this week the big storylines are this Fed rate, now employment today, and earnings all week. But before we did, what is this that you pulled up here on the chart?
Well, another thing that folks like to always pay attention to is how January turned out, right? We're in the first days of February, and maybe we should take a moment and look at how January turned out. This right here is a monthly bar, and it shows that January was an up month. And a lot of folks, and if you look back statistically, what happens in January tends to be a bellwether for what happens the rest of the year. So since January was an up month, folks are really kind of subscribing to the idea that maybe 2023, despite all of the rhetoric going into 2023, might be a good year after all.
Well, we'll definitely keep an eye on that. If we were to gauge whether individual companies feel that way, I think the earnings reports are coming out fairly mixed. I thought the big surprise that I saw was Apple, right? Apple's revenue is down, partially because they probably haven't come out with a product in 6 years. Everyone's on, iPhone version 74 or something.
Yeah, and despite those earnings being down, if I just pulled up Apple's chart, investors are kind of excited about Apple. They're excited definitely about Facebook, or the new parent company. You can see it after earnings. Meta jumped up. Tech stocks in fact, equities overall seem to see money going back into them, Sib.
Yeah, and we'll dig into a little bit more. If anybody's watching, listening for the first time, we do want to invite you to AJ's daily workshop. So if you're tuning in and you're wondering to yourself, well, what are these guys going to be talking about? What are they going over? It's options trading. It's using options to take advantage of market movements. And AJ's been doing this for the past 20 years, educating new traders, intermediate traders, experienced traders, traders of all levels. And so we want to go ahead and invite everybody to that workshop. So we're going to go ahead and throw the link into the chat. So if you haven't checked it out, you can certainly go do that. We're going to take a break and come back and talk a little bit more about earnings and the tech sector, and dig into some more of those numbers there. So stay tuned, everybody.
I get it. You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you, along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
And as always, throughout the show, if you have a ticker, a stock that you want AJ to review, go ahead and throw it in the chat, and we will do our best to run through it. But before we dig into AJ's pick of the week and our speed round, let's talk about tech. Let's talk about the tech sector. Let's talk about tech stocks. We did our piece on AI yesterday or last week, and so this new technology, these robots doing all this heavy lifting for us, is really starting to become integrated into everyday life. And so I'm assuming that's good for tech companies and tech stocks, but we're at this phase where, it's 2023. There hasn't been too much new involvement in tech. Are they going to be fizzling out, or who are the leaders? What are your thoughts on the tech industry in general?
Well, yeah. So, first of all, let's go into kind of the bigger macro picture of just a brief history of the last 6 months. So, in the last 6 months, the Fed's been selling off bonds and they've been tightening, they've been putting basically a tax on money. And so that has actually created a bond market again. And a lot of money has flown out of equities and anything that was a risky investment, meaning things that didn't really even exist, like crypto, right? These are just thoughts in people's minds and assigning value to computer code. A lot of the money has flown out of these type of things, and any sort of equity, any sort of company that had a great idea, went public with that idea, but never turned it into an actual business. Money was flying out of that and going into this newly reestablished bond market. And so fast forward, that happened in the fall. And of course, when the Fed had been selling off bonds, bond yields went through the roof. We can see that in the housing market. So the housing market, all of a sudden, mortgage rates back in October had jumped from almost like nothing to like 7%, which in people's minds was crazy. It pretty much stopped the housing market. Money was flowing into bonds. Well, guess what happened? So much money's been flowing into bonds and things have been moderating nicely that those mortgage rates came down. The housing market seems to be reinvigorated. It seems like people don't care really that mortgage rates are at 6% compared to what they were before. They don't look at the absolute number. They're just happy that it's off of the peak. So long as it's off the peak, buying has started again. And now money is starting to flow back into equities, but it's being very trepidatious. So I listened very carefully to Mark Zuckerberg when he was doing the Meta earnings press conference, and he kept emphasizing on efficiency and making the company more efficient in 2023. And what that basically says to me is that he was appealing to investors that know that right now your company has to be profitable. Your company has to be a well-oiled machine whose primary purpose is to turn profit. And if you can prove to your investors that you're turning short-term profit, then you're in a good seat to have a competitive advantage during these times. And so, yeah, because he said that, Facebook jumped up close to 26%. Now, mind you, Facebook's down 60% since their peak, but still a one-day hike of 26% is pretty awesome. And so I think that's going to be the differentiator, Sip, is if these companies like Apple, for instance, also is doing well. And you're right. They didn't quite impress with anything, but just take a look. They've got solid earnings, meaning they make money. And in addition, they give a ton of that money back to investors in the form of dividends. So these are all things that no matter how many bells and whistles you have for the future, no matter whether you're implementing AI or not, these are kind of the things that push investors over the edge. But the main core components in order to get a tech stock funded right now is that it has to be a viable business. And I think that's what we're seeing.
Yeah, and I'm just kind of looking at some of the Apple earnings, and I think they're comparing it to when they were, I feel like consumers aren't spending as much, and that's kind of showcasing across the board, right? So revenues down 28% year over year, or Mac revenues, iPad revenues down, gross margins roughly the same, bookings. So yeah, the main storyline here, I guess, is money, big money, investment dollars are moving out of tech into bonds. And so now these companies can't rely on that extra umph in their stock price, and they have to go back and focus on their businesses. I think we're also seeing a lot of layoffs from this, right? Companies are being very efficient, as Mark Zuckerberg said, efficient in improving their employment processes or just their employment structures, which I think makes sense because some of these companies are huge at this point. Like,
yeah, bloated. Yeah, I think they're bloated, and I think that's exactly right. And I do think that the dollars that will flow back into the equities, that like during times like this right now, where all of a sudden after just a few months bonds are already falling, and so people have their money and they're like, well, maybe I do have a more, that people aren't going to just willy-nilly throw their money into the markets again. I'm looking at stocks like Bed Bath and Beyond, Carvana, Peloton. Those are the ones that we have featured where Wall Street's kind of said, you're done. And if you can be a tech stock and you can show that you're a valid business, I think you're going to be okay. In fact, not only are you going to be okay, but those ones that survive are going to be the ones that are stronger coming out of this.
Yeah, I feel like we're definitely in for a unique employment shift over the next 6 months, because whenever I log on to LinkedIn, I'm seeing talented people working at these big companies getting laid off, right? Google, Amazon, Facebook. And so, a lot of talented people out there, but the employment numbers are still strong. These tech companies are laying off, right? Very interesting dynamic that we'll keep an eye on.
One of the things that we do with our options trading is we do look for pretty solid, if not boring, but still solid underlying companies. And so we look at these fundamentals, at least for a primary screen. We don't want to be trading options on any sort of symbol that might throw especially with the way we trade options. We don't want any company to all of a sudden throw a curveball to the investors and have the investors freak out and start buying and selling the stock because of these curveballs. So looking for a strong fundamental and having companies actually at this point motivated to be strong is going to help us in our options premium selling.
That's right. And like AJ said, he and the team at Trading Trainer like to find the boring stocks, right? He likes to create these option strategies around these boring names that are consistent and win over time. And so with that being said, I think your pick of the week might be considered a boring company, although I did read an article that your pick of the week, General Motors, this week signed a deal with Netflix to low-key put their electric vehicles in some Netflix content so that they can compete with the aura and the coolness of Tesla. And I thought that was a very interesting approach to that legacy type of company trying to reinvigorate themselves to be, kind of the cool kids on the block again.
GM put out a press release, if you guys have been paying attention, where they kind of raised the bar and put the line in the sand for Tesla. They said that by 2025, they were going to be kicking Tesla's ass as far as EV sales. So the line has been drawn, and I think those two companies might start going to war. But Tesla's got all those companies biting at its heels. I mean, the number of EVs being released in the next 3 years, models, makes and models, is just through the roof. So Tesla, we'll see if being first to market is what, establishes you, or if you've got these new car companies and these established ones that have been around hundreds of years can really use their translate into the EV market.
And real quick before you dig into the trade,
Yeah.
I think the way Tesla is competing, especially this week, is with the release of their truck. Right, there's these pictures coming out in San Francisco of this beta truck out on the road, and GM is a truck manufacturer, so maybe Tesla's got the counter to say, hey, we're gonna have the coolest, hottest truck on the market. come get us, GM. So it's going to be an exciting, few months to watch all these new products coming out.
Well, and you've already got out on the road the GM Hummer. The electric Hummer has already been going everywhere. You've got the new electric Cadillac, the Caddy, the big giant, looks like a Suburban, but it's a Cadillac, is out there. And I believe that the Rivian is starting to ship. And I know that the Ford has their F-150 Lightning out there. So, yeah, I almost feel like Tesla, sometimes they push their dates. I feel like now that there's some competition in these different classes of automobiles, Tesla won't be able to do that much anymore because they're not the only player. If you've got the Hummer out there, you've got the Caddy out there, you've got the F-150 out there, you're not going to be able to keep pushing your end date because you won't remain competitive. So we'll see if that even puts more pressure on Tesla, let alone Tesla putting pressure on these other companies.
I mean, I could see myself driving that truck, and in my opinion, it's like the most futuristic car on the market. So like if we see those trucks zooming around, it's like, oh man, 2023, the Jetson era, we're here.
Yeah, you never know. The other thing Tesla has done, which kind of pissed off existing customers, is they did some real major price drops. I've noticed a couple of their they looked at, I think, the new legislation from the US around pricing and what will receive the federal subsidy, and they reduced their price of their Model Y and their Model 3 in order to meet that. And then they also, on their high-end cars, the Model S and the Model X, took a huge chunk out, which kind of, those existing customers that had been waiting for their car for 6 months and who had paid the high price, they were like, hey, what the heck? But I mean, dropping prices will get more people interested for sure.
Sure. All right. So looking back at General Motors, at first glance, it looks like we're hitting some resistance there.
Yeah, exactly. Well, first of all, we featured General Motors last week for a different reason, and that was because of their earnings play. Now, we didn't make as much on the earnings play because the earnings play really does its best if the stock doesn't move much on the next day. And in this one, it did move. It moved about $2 or $3. So we only made about 8% on our earnings play, which isn't bad at all for, holding a position for under 48 hours. Which, by the way, a lot of people were sending me messages and saying, do your earnings plays get you in trouble with the pattern day trader rule? And this is a weird rule that says if you open and close positions in the same day too often in a week, you have to meet certain requirements because you're now categorized as something called a pattern day trader. And one of those requirements is to have I believe it's a $25,000 portfolio. And some of our smaller investors, don't have that much. They're just playing around with a small, like $5,000 or $10,000 portfolio. But these positions we're holding from one session to the next, right? So they don't get you in trouble with the pattern day trader rule. With that said, now that the earnings is behind us, I'm back to my premium selling on GM. And you're exactly right, Sip. It looks like we're coming up on a level of resistance that has been tested quite a few times over the last months. And so I'm watching this because as soon as it tops out and starts heading back down, that's the perfect time for me to be thinking about a premium trade. If I'm already in this position with an initial covering position, I could then think about the premium trade that comes after that. If I'm not in it, then setting up an initial covering position. Basically, just to remind people, when we're selling premium, we do it on opposite sides of the channel. So whenever we detect a reversal, we do a transaction, and that's about it. So whether it's, picking one side or the other and setting up your initial covering position, and then the opposite side, you're going to do your premium trade. And then you're going to undo your protection and then rinse and repeat like you would do shampoo, right? Over and over and over until the position cashes out, usually 5 to 8 months from now. And so It just depends where you are in that premium selling process, whether you have that initial covering position in place. And so if you're on the opposite side of that channel and we detect a reversal, you're going to be in premium selling mode. If instead you're waiting to get into this as a position at all, then the first thing you do is you establish that initial covering position. Whatever side of the channel you're on, I'm recommending it this week because you're exactly right. It looks like we might be forming a reversal. And so it's time to start premium selling all over again.
Yeah, and the price there is what, 40 something right now?
Yeah, so you're going to need a slightly larger portfolio to do this to keep your risk in check. But what I like about Jocks is, number one, the options are traded every dollar, and number two, there's definitely no shortage of people who are in the options market. So you're never going to run into a situation where you're ready to buy or sell an option and nobody is ready to sell or buy the option to you or from you. So there's so much liquidity. If you can make it work, I would. If you've got a portfolio, you've got a retirement. What's great about selling options is you can do that in a retirement portfolio. I would totally do it. This is a great stock to be doing that against.
Awesome. So that's AJ's pick of the week, General Motors.
Mhm.
Not an earnings play, the premium selling play. And so feel free to check out some of the previous episodes where we go over GM, but GM is one that we tend to bring up and talk about all the time.
One of my
With
faves.
that being said, before we get into the speed round, we do have a pretty good question that's come in that I think AJ, it'd be nice for you to answer. And so here's Mike. I'll go ahead and read it out. All right, Mike, I've watched your programs before and impressed by your approach. Is your training suited well for those retired? There's a little bit more, where someone can create a steady monthly income and get away from dividend stocks that seem to offer little opportunity to increase income aside from selling covered calls, which doesn't always turn out quite well. What are your thoughts, AJ?
So this is actually, and a lot of times what you have to realize is that you need to change your mentality. So folks that are used to being traders, I would say that if you're a trader, you're not going to be able to generate an income because their whole psychology and mentality is different. But if you can change your mentality to being more of like one of these mutual fund managers where you're going to be the manager of your own fund, and your fund is going to be focused on selling option premium. So that means your goal is to create a pipeline of underlying symbols that you're going to be looking at. You're going to be first creating trade plans for that not only include, price targets and position sizing, but also include things like what triggers, what signals will I receive? And then you actually go through the process of back testing and forward testing these signals and making sure that this symbol is going to work in your portfolio. And only those symbols that are working in your portfolio in your testing process do you actually put into real money. And then you get into this management process where instead of looking for new candidates to trade and quick money to make, what you're doing is you're going into your portfolio and you're actually every evening just managing it, determining what positions need adjusting in the next day, if any, and am I getting any that cash out and what new symbols. So it's more about managing and holistically managing a invested portfolio than it is making these 2-bit trades. So if you can do that mindset change, which is what I teach in my program, that's exactly the target that for a retired person, this would be right up your alley because yes, you can create an income. And at the same time, when you get into this mentality of being a fund manager, you're not going to be spending all this time during the day watching charts. Instead, what you're going to wind up doing is finding that you have a whole bunch of free time during the day. And just a couple of minutes in the evening is what you do, where you visit what has happened, you decide if anything has to happen the next day, and then you're done. So it's targeted right at you, but you do have to kind of make sure you're in the right mindset. And then, of course, the big elephant in the room is you also have to make sure that you have enough investment dollars to create an income, right? Because this is investing, and investing by definition means taking your money and using it to make more money. So if you don't have that money to begin with, you're not going to be able to create a livable wage off of that to begin, to go forward. So a lot of times what I've been telling some folks who are not quite ready to retire is, hey, if you can work on your portfolio and roll those returns in for a year or two and wind up growing that nest egg, that golden goose, grow it before you start taking eggs from it to live on, that's even better.
Yeah, and with that, Mike, I would recommend signing up just or head on over to the link that we just posted in the chat and just have a conversation with someone on our team, right?
Yeah.
You'll be able to ask specifics on the how big your portfolio is, how much the program costs, and like AJ said, you could just learn everything, or you could work with him, his team, and the whole community at Trading Trainers, so that you don't feel so alone, so that week to week you're getting confirmation from others that they're looking and seeing the same things, and then it just makes that process a little bit more of community based rather than you being alone out there. And so AJ's got a lot of ways to help. He's been doing this for 20 years. The link is in the chat. Go ahead and sign up. Appreciate you tuning in, Mike. Great question. Glad that one came in. So let's move on to the good stuff. People that have been in your program and people that are in the community week to week have some tickers that they want you to look at. So the first one in our speed round today is an entertainment company, Penn Entertainment, and this is Bobby from Detroit, Michigan. Penn Entertainment, ticker symbol PENN.
All right. So I have not traded any options against Penn before. So I'm looking at this with fresh eyes. I did take a quick look at Penn Entertainment and realized that they're kind of into, when they say Penn Entertainment, they're talking about like online gaming, like casinos and stuff like that, which is cool. I see that they're a profitable company. For the last 3 earnings, they've issued a profit. That's great. They are in a sideways channel, and that's really good for us premium sellers, meaning we can probably turn this into an income stock. It looks like they're coming off of their highs from a couple years ago when people were stuck at home during the pandemic and they were, probably doing stuff online. Now that people are out getting out again, we kind of have stabilized. But again, that's really good for us who are going to turn this into an income trade. And so coming on back to a 6-month chart, I'm curious if I'm testing a level of resistance here. I did get a signal on one of my favorite indicators called the Fast MACD that maybe we did get a reversal signal yesterday evening. I don't see that it's quite a validated reversal signal. Instead, I feel like it was a response to the earnings that happened. And today we're not getting follow through. So I think that you have to, we teach folks not to trade until they see the whites of the eyes of the signal. In other words, there was a don't shoot until you see the whites of their eyes was a line in a cowboy movie back in the day. So I'm saying don't pull the trigger on this trade until you're sure you have a signal. But yeah, I think that you could set up a nice premium selling trade plan here. The initial covering position would be either to short some of this Penn Entertainment stock, or you want to buy some back month deep in the money, far out in time put options. And that would be a initial covering position so that when you then swoop down across the channel and then probably find some support between $26 and $28, that's when you would sell your premium and make that into an income trade. One thing I always like to do is check the options. And so I'm looking at the options. They're trading every $5 above the $25 mark. Let me just look over here. So $40, $35, $30. It makes it a little bit more difficult when the options have strike price increments that are more traditional rather than every dollar. But this one looks like you could still make it work. But you'll have to put that into your planning. But yeah, I see some pretty healthy liquidity. The bid-ask spread is not too far apart. So yeah, I think this is a doable trade, but just plan it out well. Plan your trade and then trade your plan. Don't deviate. Keep that discipline.
Yeah, and one of their big moves this year, last year, was the purchase of Barstool Sports and Barstool Sportsbook, and they've got an interesting business because they've been opening up these sports books / restaurants / bars. And I think there's a big one in Detroit, which is probably where the interest came from.
Bobby.
But they're they have an interesting model because it's gambling and now entertainment and now the industry or
rolling it all
hospitality. Yeah. So I'm a big fan of Barstool Sports. So that was the big news a few years ago when they got acquired.
See, I never heard of them. So that's cool.
Yeah, well, their CEO is rather eccentric, and he trades and he gambles and he's out there. So he does pizza reviews, right? Very entertaining stuff. Big fan. All right, well that's one exciting name, right? Penn Entertainment, Barstool Sports, and now we're gonna move on to something a little bit more boring. And this is Bethany from Cedar Rapids, Ohio, or Cedar Rapids, Iowa, is interested in AT&T. Probably one of the originals, right? One of the OGs in the stock market game, AT&T.
They've been around for forever, but boy, they're a much different company than they were back in the day. Now, they own things like CNN and HBO, I believe. So they're quite a diverse company. They're not just in telephones. I'm looking at a 2-year chart just to get an idea of where we're at, because when you look too close and look at a 6-month chart, you might be saying to yourself, I don't see a trade here. So this is more of a long-term player, I think. Here's a 1-year chart, trying to get an idea of where tested support and resistance are. For some of you technicians out there, I would recommend using some sort of point and figure chart on this. I don't have one to pull up for you right now, but using a point and figure chart, we can see reversals better, and even better if you can have an indicator and overlay volume by dollar. We would be able to see our support and resistance levels. But just looking here, I feel like we have some sort of tested level of support down here, maybe at the $17.50 line, $18 line, and some sort of level of resistance somewhere between $20 and $21. And so and you can see AT&T, very boring stock, but cash flowing positive, giving back money to the investors. These are the kind of the stocks we're looking at. Perhaps giving us a top signal today for us to follow up on Monday. We'll see by the end of the day, but so far it's kind of materializing that way. Let me zoom in a little bit more. I don't even have to look at the options chain because AT&T is such a popular company that the options market is very healthy. And you can see they're trading every dollar. So you've got all the option choices you want. I would almost say that we could turn this into a premium trade. You could turn this into one of those trades where if you want to have AT&T in your portfolio for the long term, use some naked puts or what we call cash secured puts in order to buy this at your price. And if you don't get a chance to buy it at your price, they pay you a finder's fee basically anyway. So I could see doing that, or I could see setting up a initial covering position similar to what we were looking at on Penn, either shorting some AT&T stock or buying some deep in the money far out in time puts. And there's nothing wrong with doing both strategies, owning some AT&T stock for the long term, just keeping it in your portfolio for the long term, and at the same time doing some medium term premium selling. In fact, I could also see why when earnings rolls around again, it's not going to be for about 3 more months, but when earnings rolls around, AT&T is another great candidate for doing earnings plays on. So you can have the same underlying symbol and apply different strategies at different times and just keep that underlying symbol working for you. And so I recommend that to my users as well, because these symbols and the investors that trade these symbols, that create these price charts for us, you start to get to know them the longer you're around them. So you start to know when they're going to flinch and when they're going to remain confident and remain solid. And so I always ask folks to create long-term relationships with their underlying symbols, and then just apply the option trading tools that are working in the moment on that symbol, rather than being, again, trader mentality versus long-term investor mentality, rather than being one of these traders that's constantly looking for the next underlying symbol. You never get a chance to really bond with that symbol, bond with the investors that move the money on that symbol, if you're always looking for the next shiny object.
Yeah, well, AJ, you've been bonding with these symbols for almost 20 years now. So, and AT&T is as boring as they get, but we'll take it. We'll take a look at it. It's priced very well, so that's a good
I've
picker.
traded AT&T a lot.
I would imagine. Yeah, I would imagine. All right, thank you, Bethany from Cedar Rapids, Iowa. Hope you're staying warm out there. Now we're gonna move across the continent. This is Tommy from Hong Kong, China. He's interested in XPeng, ticker symbol XPEV.
Speaking of the EV market, now I like to focus on the EV market here in the States because I'm just interested in, I live in the States, but man, there are so many people in China, and because of the way that China operates, they have a very efficient government because they're an autocracy. So whatever one person decides, that just happens to be what gets implemented really quickly. And so they're actually incentivizing their bazillion people to buy EVs. And so the EV market there is something, at least for us investors, to kind of be in tune with. This is one of those companies in China catering to the EV market. Another one we featured is NIO, so keep your eye on NIO. Listen, this stock is what we call consolidating. Here's a little tip. When you have identified support and resistance, and here it looks like it's about $9.50 and maybe $11, take that number, that width of that channel, and divide it by the average channel price and see what sort of ratio you create. If that ratio is under 10%, you can categorize this symbol as, consolidating or converging. So this probably is not a premium trade. This is probably more like a potential breakout trade. And so I even caution you, Tommy, to maybe, unless you really, really know something that I don't, which is possible, about this company, you may not want to have this stock in your portfolio for the long term until this is more established as a company. So I wouldn't even suggest doing cash secured put buying and then ultimately buying the stock. I'd prepare for this for a breakout. And so there's a couple of different ways to trade this breakout. You guys might want to pay attention because I'm just going to rattle these off. One is making money on the stock, whether it goes up or down. And so there you'd be thinking about a straddle or strangle, and you'd be thinking more farther out in time to get that directional optimization on the stock. So 6 months out with a call and a put, either at the same strike price or spread it out, straddle or strangle. That would take advantage of any sort of breakout that occurs. If you think that there's going to be a implied volatility rush, a increase in implied volatility, then we would do a straddle or strangle, and we would go more like 1 month, 1 or 2 months out. And then finally, you could do an active trade where you're either going to trade this stock or you're going to trade substitute options. And you can do that by, programming in some alerts and some automatic trading to detect the breakout, whether it goes up or down, and then try to jump into that trade. That would be a very fast trade. So there's a couple ways to trade it, but I would be trading the breakout, whether it be a implied volatility trade, whether it be a passive directional trade, or whether it be an active directional trade. So that's getting into some more kind of trader behaviors. I think there's some more reliable income trades out there, but this is kind of a fun stock to take a look at. And they do have a lot of interest in the options market. There's people trading these things. So I think that there's those three types of trades. People are preparing for them already. So you're going to have to do some comparison. Not sure this is something I would do because I'm getting old and not interested in doing this type of almost day trading anymore, but it's exciting.
Yeah. And what's the number again of how many different ways there are to trade options? Like 20, 27, something like that?
I think that the mathematicians out there have just added one in the last 10 years. So it was 26. Now it's like 27 different ways. So if you can identify the patterns, even the hidden patterns that you're seeing in an underlying symbol, you can then go to your tool chest and through option strategy selection and then through the individual option selection, strike price and expiration date, you can tune these tools to meet whatever situation you've identified. And I get into that often, especially in my one-on-one mentoring SIP with some of my clients, because I want them to be able to see what they see and then trade appropriately to create an ongoing return.
Yeah, and 27 different ways. So you pull up one stock, there's 4 or 5 different approaches. And that's why we do the show. That's why we do the speed rounds, to give you some insights. But if you want to be a part of the community, if you want to get involved with AJ's one-on-one program, the links are in the chat. So head on over there, sign up. If you've enjoyed the broadcast,
please subscribe.
I believe it's episode 67. So we've been cranking these bad boys out. Hit that like, hit that follow, hit that subscribe button, like AJ said. All right. Well, February just began. We just got our first rate hike of the year. What should people be looking forward to?
Well, I think that we should see how investors come back next week after they've thought about this employment report. Was it too good to be true? But, we're in February. If you can find some signals and sell some February premium and get yourself set until the third Friday of February, which is going to be in 2 more weeks, I would do that because that's what I've done. I've got my February premium sold wherever I can on all my positions. And now you just basically wait. You wait until the third Friday of February, and that's when you're going to have to take your next action. So really, it's all about just kind of being in cruise control and letting that ATM machine cha-ching every third Friday of the month.
Yeah, but you're going to be busy this week studying the playbook and hitting the gym, so you're ready for the Super Bowl, right?
That's right. AJ Brown. AJ Brown. Yeah. And I've got some calls lined up with some of our mentoring clients. And so we'll be talking to them throughout the weekend. So I'm excited about working with them. I always like to see our mentoring clients do well. We kind of, this, SIP, but for those folks out there, we put our skin in the game with them. They don't just come to us for service. We make sure that by the time they're done with us, a year from now, that not only have they made back all the money that they spend on our mentoring program, but that they have a system in place that they've been using for at least 6 months and that they know how to keep it running so that when we do say, hey, we're done, you're ready to graduate, you're ready to go out it on your own, kick you out of the nest and you're going to fly, that you can fly with confidence.
And we know that anybody that's watching that's new probably gets hit with a lot of, trading education ads and gurus. But the reality is that AJ's been doing this for 20 years, right? 20 years, 20 years of students, 20 years of consistency, of just delivering a quality product, which is the education, the community, and just the ability to utilize your portfolio to generate income. And so if you haven't checked out the webinar, head on over. The link is in the chat. If you want to learn more about the one-on-one, the link is in the chat. AJ, thank you for your time. Everybody, I appreciate you guys tuning in. If you have any questions, drop them in the comments, send us a DM, and someone will get back to you as soon as they can. Otherwise, enjoy the weekend, my friend.
Take care.
Thank you for tuning into the AJ Brown Show. If you're interested in learning more about AJ and his investing techniques, head on over to tradingtrainer.com and create your free account today. And if you're not already a subscriber to the show, hit that subscribe button and we'll get you fresh content daily.